Hey everyone, welcome back to the channel. Today, we're re-diving deep into a topic that's been buzzing all over the internet, using crowdfunding to build passive income streams. You see these platforms everywhere, promising you a piece of the action in real estate. Startups, or even creative projects, all for a relatively small investment. It sounds like the dream, right? Putting your money to work for you, kicking back, and watching the cash roll in. But is it really that simple? Is crowdfunding the golden ticket to financial freedom? Or is it a risky bet that could leave you with empty pockets? In this video, we're going to unpack all of it, the good, the bad, and the ugly. We'll explore how these platforms work, what kind of returns you can realistically expect, and most importantly, the hidden risks that many people overlook. So, if you've ever been tempted to jump on the crowdfunding bandwagon, stick around. This is a conversation you can't afford to miss. First things first, let's break down what we're talking about. There are a few main types of crowdfunding. You've got donation-based, which is like what you see on GoFundMe, where you're not expecting a financial return. Then there's rewards-based, like Kickstarter, where you get a product or a perk for your contribution. But for passive income, we're focused on two specific models: debt crowdfunding and equity crowdfunding. Debt crowdfunding is essentially peer-to-peer lending. You lend money to a business or a real estate project, and in return, you get paid back with interest over a set period. It feels a bit like being the bank. Your passive income here comes from those regular interest payments. The appeal is that the interest rates offered are often much higher than what you get from a traditional savings account or a bond. Then there's equity crowdfunding. This is the one that gets a lot of hype. Here, you're not just a lender, you're becoming a owner. You're buying a small piece of a company, usually a startup or a small business. If that company does well and its value goes up, so does the value of your share. The passive income dream here is a bit longer term. You might get dividends if the company becomes profitable. But the big payoff everyone hopes for is an exit event. Like the company getting acquired or going public, where your small investment could multiply many times over. It's the venture capital dream, but made accessible to the average person. On the surface, both sound fantastic. They lower the barrier to entry for investing in assets that were once reserved for the ultra-wealthy. You can get into real estate for a few $100s instead of needing a massive down payment. You can invest in the next big thing startup for the price of a nice dinner out. The platforms themselves are usually slick, easy to use, and they present you with a menu of opportunities that all look incredibly promising. They give you the documents, the projections, the business plans. It feels professional, it feels legitimate, and it makes you feel like a savvy investor. But this is where we need to press pause and look a little closer. The story presented on the platform is always the best case scenario. Our job as smart investors is to understand the worst case scenarios. Let's start with the biggest, most obvious risk: the potential for total loss. This is especially true for equity crowdfunding. The vast majority of startups fail. That's not being pessimistic. It's a statistical fact. For every one company that becomes a household name, thousands disappear without a trace. When you invest in a startup through an equity crowdfunding platform, you are taking on that exact same risk. If the company goes bankrupt, your investment is gone. Poof, vanished. There's no government protection like you have with a bank deposit. That money is wiped out and you get nothing back. The high potential for reward comes with an equally high potential for complete and total failure. Debt crowdfunding might seem safer, and in some ways it is. You're a lender, not an owner, but you're what's known as an unsecured creditor in many cases. If the business you lent money to goes under, they have to pay back their secured creditors first, like the big banks. By the time they get down the list to the crowdfunded lenders, there's often nothing left. You might get pennies on the dollar, or just like with equity, you might get zero. A project can run into delays, go over budget, or simply fail to generate the revenue it projected. When that happens, your passive income stream of interest payments can dry up instantly. The second major risk is illiquidity. This is a huge one that people don't talk about enough. When you buy a stock on the New York Stock Exchange, you can sell it in seconds if you need your money back or if you think the company is heading for trouble. That's a liquid market. Crowdfunded investments are the complete opposite. They are highly illiquid. With equity crowdfunding, there's no secondary market to easily sell your shares. You are locked in. Your money is tied up until that exit event we talked about, which might take 5, 10, or even 15 years, if it happens at all. With debt crowdfunding, you're locked in for the term of the loan, which could be several years. You can't just pull your money out if you have an emergency or change your mind. That money is gone from your accessible funds until the investment plays out, for better or for worse. Next, let's talk about the lack of due diligence and transparency. The big venture capital firms and banks have teams of analysts who spend months vetting a company before investing. They tear apart the financials, they interview the founders, they analyze the market. You, as a small crowdfund investor, don't have those resources. You are relying on the information provided by the platform and the company itself. And guess what? The company is trying to sell you on their dream. They're going to present everything in the most positive light possible. The projections might be wildly optimistic. Key challenges might be downplayed or omitted entirely. It's very difficult for an average person to spot the red flags in a business plan or to truly verify the claims being made. You're essentially betting on a story, and you have to be comfortable with the fact that the story might not have a happy ending. Another point is diversification or the lack thereof. A classic rule of investing is don't put all your eggs in one basket, because crowdfunding feels so accessible. It's tempting for new investors to put a significant chunk of their savings into one or two projects that they really believe in. This is incredibly dangerous. If you put $5,000 into a single startup and it fails, you've lost $5,000. If you had spread that same amount across 50 different startups, the failure of one wouldn't hurt as much. The success of just one or two could potentially cover the losses of many others. But achieving that level of diversification through crowdfunding requires a lot of capital and a ton of research, which brings us back to the problem of due diligence. So, am I saying that all crowdfunding for passive income is a scam? Absolutely not. There are legitimate platforms and success stories out there. People have made good money, but it's crucial to go into it with your eyes wide open and to treat it not as a path to easy, guaranteed passive income, but as a high-risk, speculative part of your overall investment portfolio. This isn't where you put your emergency fund or the money you re-saving for a down payment on a house. This is money you can afford to lose. Think of it like a trip to Vegas. You go with a set amount of cash, you hope to win big, but you're fully prepared to walk away with nothing. If you are still interested after understanding these risks, how can you be smarter about it? First, vet the platform itself. How long has it been around? What's its track record? Do they provide clear information about defaults or failures on their platform? A reputable platform will be transparent about the risks. Second, read everything. And I mean everything. The business plan, the financial statements, the legal documents. Pay attention to the founder's experience. Do they have a history of success? Or is this their first time at the rodeo? Third, as we discussed, diversify. It's better to make 20 small investments of $100 each than one big investment of $2,000. Spread your bets. And finally, never ever invest more than you are willing to lose entirely. I can't stress this enough. If the thought of your investment going to zero gives you anxiety, then crowdfunding is not for you. To wrap this up, the idea of crowdfunding for passive income is incredibly alluring. It promises to democratize investing and give everyone a shot at high-growth opportunities. But the reality is that it's the Wild West of the investment world. It's filled with immense risk, a lack of liquidity, and potential information gaps. It can be a part of a well-rounded, high-risk investment strategy, but it should never be mistaken for a safe and steady source of passive income like high-dividend stocks or traditional rental properties might be. The marketing makes it look easy, but the reality is anything but. Be smart, be skeptical, and protect your capital. Thanks so much for watching today. I hope this gave you a more balanced perspective on the world of crowdfunding. What are your thoughts? Have you invested in a crowdfunding project? What was your experience? Let me know in the comments below. I'd love to hear your stories. If you found this video helpful, please hit that like button and subscribe for more content on building wealth wisely. See you in the next one.